Okay, so next we have risk appetite, the financial
Yeah.
crime.
So this gets into the, who do you bank, who don't you bank, and how do you tell the difference? And you know, I start with kind of, where the respondent bank tells us, and they generally will have more of a business model than maybe a risk model on it. They may say, well, we're a retail bank that, has a lot of consumers and small and medium sized enterprise, or they may say, well, we're the largest bank in the country, so we have a substantial market share in the consumer area, but we're also handling a lot of the large corporate activity in the country, or maybe we're handling foreign activity, multinationals that are coming to set up operations in the country, whatever. So I would start with that, but then at some point in the conversation, particularly on the question of who you don't bank, I'd start asking some follow-up questions on customer types like, MSBs or trading companies or state-owned enterprises, products. Obviously we're always interested in third-party wires, but I may be asking about cash, particularly if it's a cash-intensive economy. I might be asking about international cash letter if we're just starting that. Geography, which geographies, do they find particularly high risk? Not in a few, more than a few instances. I had some of our respondents, I remember some of the Swiss banks said, their riskiest geography is the US. And actually, I agreed with them. I
Yeah.
thought, yeah, you're probably right. Uh, but there's also unique offshore financial centers that may cater uh, uh, to a particular geography. Uh, uh, or maybe there's some terrorism issues, or
Yeah.
some other things that would be concerned. And then obviously the transactional activity. At the end of the day, we all have to find suspicious activity, and we use transactions, to differentiate the people we want to bank and not want to bank. So, almost always we get down to the transactions. Uh, the key is for each of these categories, who do they reject, or in some cases, who do they spend more effort on in an effort to mitigate, maybe have specialized due diligence, or uh, you know, more approvals, or things like that. Uh, what I'm really looking for in these categories is the scope of the efforts they're doing to tell the difference between a good customer and a bad customer. And you know through success stories, or maybe the detailed ways of them discussing risk appetite, is how effective do I think they are at doing that. And almost always I'll have some topics at top of mind as far as business sectors of exposure that particular respondent bank may have. And, generally we'll get there through the activity reports where, we'll ask more granular questions, about those customers. And I'm interested in their thoughts about the activity, as well as, who was, doing the approvals and what sort of criteria they were using to approve. For example,
Right.
if I'm seeing some PEP activity, I'd say, well, tell me a little bit about these PEPs,
Hmm.
and how do you handle corruption or potential corruption with these PEPs? And very much I'm in an active listening mode, asking follow-up questions, but you know, those kind of drill downs make it much more real to me, other than just a blanket boilerplate statement saying, oh, well, we won't tolerate corruption. Like, okay, then tell me some instances that you found corruption and how you dealt with it.
Right. Absolutely. And Tom, I would be very interested in knowing your views on, many organizations, of course, not many, I think most of them, they use some kind of weightages in terms of, having their risk appetite, right? Which helps them to rate their customers. What are your views on the weightage?
Well, I think it's necessary. If let's make it up. Let's assume that you have some known PEPs or you have some known MSBs or other areas that, maybe present, some specialized issues as far as managing the risk. You should use your KYC systems,
Mm-hmm.
to calibrate the level of review. So if you know someone's a PEP, you need to identify them and assess the risk. It doesn't mean that you won't handle their activity or open the account. It just means that you want your systems a little bit more sensitive to looking at it. And on the PEPs, if you have a PEP that's, basically just having consumer type activity that's consistent with their known salary or whatever, you're going to be much more comfortable with that than if you're seeing, a situation like 1MDB where you're seeing, huge amounts of money going through a PEP account that obviously has no relationship with their known sources of income. And so
Absolutely.
I think it's going back to our rowboat analogy,
Yeah.
one of the oars is the KYC system, which obviously does have weighting and classification, and the other oar is the activity, and they need to be working in tandem.
Sure. And if I can take you back to the previous slide on annual report, the point that you mentioned, and you mentioned that this is not from credit risk perspective. If you could share your views on, what typically will you be looking for when you're reading an annual report?
Okay. So, a few months ago, I was doing some volunteer work in Mongolia. So we were visiting with all the banks in Mongolia, and I had, various things that I was looking at, including their Wolfsburg questionnaire and uh, questionnaires and annual reports or whatever. And I could see that actually the annual reports were actually quite interesting to me because they showed very, very different business models.
Mm-hmm.
One bank there really had like a dominance in the consumer area. I mean, we're talking, I forget the numbers, but it was well over 50% of the whole country would have their credit cards and their DDA accounts there. Another one, was dominant with the corporate and the transnational companies. Another one was, very tied in with development loans and stuff like that, and had some NGOs that were helping to finance them. And then there was your smaller banks. So from my perspective, uh, every bank, if you're looking at your market,
Mm-hmm.
every bank has its own personality.
Yeah.
And a lot of times that personality is defined by their customer base. Obviously it's also defined by their ownership and the people that work there as well. So,
Mm-hmm.
I spend a lot of time looking at that. And like with Mongolia, I was spending a lot of time looking their annual report as far as who are the owners and what were
Right.
the owners' pedigrees. And in some cases, you would have an owner that maybe had a conglomerate where they, made a lot of money in various uh, other sectors of the economy, and it made sense for them to own a bank to handle their own conglomerate activity as well as other unrelated customers. And that would help me understand, well, this is why I'm seeing this kind of activity. Now, when you have a bank where you're handling the banking business of non-banking companies of the owner, you have some additional questions you have to ask because you're concerned about independence and that sort of thing. But
Yeah.
for me, it's much more, every bank has a personality
Mm-hmm.
that's defined by their customer base, their owners, the people that work there, their size, uh, their products that they offer, that sort of thing.
Right.
And I really want to understand that before I go into the compliance call.
Great points. Thank you. I think that will be very helpful for the audience.